Oh, hey, hi, how you doing there? I didn't see you come in. Glad you stopped by. I was remembering that story you were telling me. Your friends Joe and Rita, they invited you over for dinner, and you were telling me that after dinner, they said, listen, we want to have a conversation with you. Listen, what's the problem? Well, they usually turn to you in matters of like accounting and finance and taxation. Joe says, Rita here is kind of bugging me. She wants me to like listen to a guy for life insurance for Pete's sake. We're almost retired. The house is almost paid off. The kids are out of the house. What do we need life insurance for? So Rita, what do you think you need it for? Rita says, I got a friend of mine. She's a widow. We're in a similar situation. Her husband passed away. They had money in an IRA. She says it's not working out so well. Her taxes are up. They're draining the money. They didn't really plan for this very well. Joe says, that's crazy. She passes away. She's got all the money in the IRA. It all goes right to her. You don't have my spending. What's the big deal? So I said, okay, Joe, okay. Let's take a look at the situation. Let's look at the numbers. You said you have how much? He says, I got $450,000. My financial planner says when we retire in a couple of years, $450,000. Okay, and how long is that going to last? He figures we could take out $30,000 a year for 20 years. Then it'll get drained. Okay, what about Social Security? Yeah, Social Security is good. Joe says, I'm going to get $2,000 a month, $24,000 a year. Rita here is getting $1,500 a month. You add them together, we get $42,000 a year in the Social Security, $30,000 we're going to drain out of the IRA, $72,000 a year. I think we can do okay. We'll do some traveling. We want to see the country. Okay, well, Rita's concerned about what's going to happen if you pass away first. What's going to be left? He says, what's the big deal? I said, well, let's take a look at the numbers. So right now, Social Security gets taxed in a certain way. There's its own formula for taxation of Social Security. Just as I didn't know that. Yeah, well, here, take a look. So right here you have, it's called combined income, provisional income. What you have to do is you take 50% of your Social Security, you add in your taxable interest and dividends, your tax exempt, your pensions, your withdrawals from your IRA. So in this case, you have $42,000 in Social Security, 50% is $21,000. You're withdrawing $30,000. You have $51,000. Then it gets to this, graduated bucket, and this is for the rates for a married couple. So as you can see, none of it's taxable for the first $32,000. From 32 to 44, as you can see, is 50% taxed. And in excess of 44,000, it's 85% taxed. Although the total will never exceed 85% of your Social Security. So here, of the $42,000 in Social Security, under the scenario, $11,950 is going to be subject to tax. Okay. All right, Joseph, I get that. Good. What's next? Well, here, let me show you. So now let's calculate how much tax you're going to have. You said your Social Security portion was $11,950. You're withdrawing $30,000. That's a total of $41,950. You take out your standard deduction, and in the year 2022, for a married couple, it's $25,900. And you said you're 65 years old. You add another $1,400 for over age 65. Your standard deduction is $27,300. You subtract that out of that $41,950, you get $14,650. Look at that, Joe, you're in the first tax bracket. Yeah, you're 10% because you haven't even eclipsed the highlight of $20,560. You're paying $1,465. That's a good explanation. I understand that. Thank you. Now what happens if I pass away? What happens with Rita? Okay, well, you may or may not be aware that when you pass away, Rita has her option. She can either take 100% of her benefit or 50% of the spouse, whichever's higher. So since you're making $2,000 in Social Security, 50% is $1,000. She's got $1,500 of her own. That's more. She'll keep her own $1,500. She'll have $18,000 in Social Security. That's a big cut from what before you were having $42,000, right? Now we go into the formula again, like before. So take a look here. So she's making $18,000. There's two columns here. I got two scenarios. The first one, once again, 50% is $9,000. She now has withdrawing $30,000. That makes a total of $39,000. Once again, you go through the little Now here, the rates are different because she's a single taxpayer. So those Social Security, how much is taxable for Social Security, the numbers change. More is going to be taxed. So in this case, $87.50 over $18,000 is going to be taxed. She's got her $30,000 withdrawal, but her standard deduction now has gone down because it's not the two of you, it's just Rita. That goes down to $14,350. Your taxable income is $24,400. What happens if she wants to take out more money, Joe? She might find that difficult to live on that. She's still got a lot of expenses. Say she takes out $43,200. That's a number I kind of came up with somewhat arbitrarily. You were telling her. You were telling it somewhat arbitrarily because that's 85% of all that income you had before. You figure maybe she could live on that. You take that out, $43,200. The formula goes to $52,200. Well, now you're going to be taxed up to all the way up to 85%. You can see there, it's going to hit the 85% threshold, $15,300. Plug that into your taxable wages again. Of her tax of $18,000, $15,300 is getting taxed. You're withdrawing $43,200. You go through the standard deduction. Her tax is now $44,000. Her taxable income is now $44,150. Let's see what the tax is going to be under those two scenarios, Joe. Right here, let me show you. So the first half of this sheet's the same. It shows you how we're under the two scenarios. It's $24,400 and $44,150. Now these tax rates down here for single people, right, Joe? The numbers are smaller. That's because you got a single individual. Well, based on her first column, $24,400, her taxes go up to $27,23. They're going higher. And if she takes more money out under scenario 2, her taxes are going up. They're going to double, $5,330. Just that's pretty interesting. I didn't realize that. Because you may not have also realized, Joe, that the taxes are going to go up in 2026. Here, take a look at this here. This is a little. You can see on the right-hand side, the tax rates are now, or were previously, 10%, 15%, 25%, 28%. Well, they changed the laws and cut the taxes. They're now 10%, 12%, 22, 24%. Those are the tax brackets. They're going to go back to 2026, Joe. When they passed the law back in 2017, they they sunset. It was a sunset provision. 2026 goes back to those old tax rates. So whether you're alive or dead, they're going to go back to those tax rates. Oh, I didn't realize that. Okay, well, let's take a look at the scenario again. Let's look at a little comparison. You're both living. You have $72,000 of income. You're paying $1,465 in taxes. If she continues, you pass away, Joe. Rita here's got $18,000 in Social Security. She takes out $30,000. She's got $48,000 to live on. Her tax is going to be $27,23. But when the rates go up in 2026, she's going to be paying $3,146. You take that out of her income there, she's got $44,854 to live on. If she wants to take out more money to live on, her triggers more tax. Look at the second scenario. She took out $43,200. She's going to live on $61,200, but her tax goes to $5,330. In the year 2026, when the rates go up, she's going to be paying $63,446. Joe says, "Holy cow, that's double." Yeah, it's double what you're paying if she only takes out $30,000, Joe. Now she's only going to be living on $54,854 after she pays that tax. Joe says, "Well, okay. She's going to be drawing out more money. What's that going to mean for her IRA?" Well, that's a good question, Joe. What happens there is you say you're taking out $30,000 for 4 years, and you pass away. She kicks into this single thing here. She takes out more money because she needs it. She's paying more tax. Every time she takes out more money, it triggers more tax. She's in the higher brackets now because she's single. Fortunately, Joe, she's going to run through that money in 10 years. Really. So let me make sure I get this, Joe says, I take $30,000 out of your 4 years. I deplete $120,000. She's going to run through the rest of that in 10 years? And you said, yeah, Joe, that's what's going to happen here. Take a look at these numbers right here. Her Social Security is going to drop from the two of you of $42,000 to just her for $18,000. Now her Social Security is going to be applied to the single marginal tax rates for taxability, which is going to make her fall into the 85% tax bracket for Social Security. Also, her personal exemption is going to decrease from married to single. It's another thing that increases your total taxable income. And all that taxable income is going to be subject to single tax rates again. Don't forget, we also talked about the tax rates are going up in the year 2026. Who says, okay, you know what, I didn't really realize all that. I thought we were fixed pretty good. Rita says, you think it's okay if that insurance guy comes over and has a talk? He says, I don't know if we need insurance, but it looks like there's some things that, we really didn't plan. And I said, so what did you think about that? Well, he was a little sheepish, but it's a good thing he came over to have dinner. He appreciated your time. I said, that's the best you can do, right? And that's why you are one ace accountant. All right, I'll talk to you later. Let's give a round of applause.